Hello learner and welcome to the Financial Management course. My name is Matrika Prasad Sharma, your course coordinator for Financial Management course. In today's session, I will be guiding into the topic fundraising. I am excited to take you to this journey and help you to build a very strong understanding on fundraising. Imagine you're starting a business and need funds to launch operations. You must decide how much money is required and where to source it. Should you rely on loans, equity, or internal reserves? How would you determine the fund requirement, and why is understanding the classification of financing sources crucial for making informed financial decisions? At the end of this topic, you will be able to explain the aspects of fund requirement, comprehend the classification of sources of finance of a firm.
Fundraising activities may include issuing shares, obtaining loans, securing grants, or engaging in other financing arrangements tailored to the organization's requirements and financial goals. The aspects of estimation in financial planning involves three key components. First is investment in fixed assets, wherein it includes expenses on land, buildings, machinery, and furniture. These are long-term assets and the funds allocated here are called fixed capital. Second is investment in current assets. It covers cash, inventory, book debts, and bills. These are short-term assets needed for our day-to-day operations. Third is cost of promoting the firm. Includes preliminary expenses for establishing a company such as market research, accounting, legal advice, and marketing activities. These aspects ensure a comprehensive approach to fund estimation, balancing long-term stability with operational efficiency. The aspect of estimation in financial planning also include: first is operating expenses, covers the losses incurred during the initial period of operations until the company achieves profitability. These are crucial for sustaining operations. Second one is financing cost, including flotation cost, wherein including expenses related to raising funds such as brokerage on securities and commissions on underwriting. These are necessary for capital procurement. Third is cost of intangible assets. Encompass expenditures on acquiring or maintaining intangible assets like goodwill, patents, and trademarks, which enhances the company's value and competitive edge.
These aspects help in accurately estimating the financial requirements for a business's setup and growth.
The classification of financial requirements is divided into two types. First is long-term capital, fixed capital. Funds invested in long-term assets like land, buildings, machinery, and furniture. These assets are essential for business operations and may fluctuate in value over time. Fixed capital supports investments that have enduring benefits. Second is short-term capital, that is working capital. Funds needed for day-to-day operations such as purchasing raw materials and covering expenses like salaries, rent, and advertising. Working capital has a permanent component and a variable component. This classification ensures efficient allocation of funds for business stability and growth. A prudent financial planning ensures that the financial requirements are met using appropriate funding sources based on the nature of capital. First is fixed capital, funded through long-term sources such as equity, debentures, or long-term loans. These sources align with the enduring nature of investments in assets like land, machinery, and buildings. Second is working capital. Working capital, funded through short-term sources such as trade credit, bank overdrafts, or short-term loans. These sources address the immediate and recurring needs of daily operations such as salaries, raw materials, and utilities. This classification ensures financial stability and optimized resource utilization. Sources of finance can be classified into three main categories, and they are: first is based on time frame, long-term. Funds raised for more than 5 years such as equity, debentures, and long-term loans. Medium term, funds with a duration of 1 to 5 years, typically used for expansion or equipment purchases. Short term, funds raised for less than a year like a trade credit and short-term loans to meet working capital needs. Second is based on ownership. Owner's fund includes equity capital and retained earnings representing the owner's contribution to the business. Borrowed funds include loans and credit taken from external sources. Third is based on national and international finance. National sources, funds sourced within the country. Second is international sources, funds raised from global markets including foreign investment or international loans.
So dear learners, in this topic we have learned aspects of estimation of fund requirements. The financial requirements of a firm are estimated based on investment in fixed assets, current assets, operating expenses, financing costs, and intangible assets. Various sources of funds. The sources of finance are classified into long-term capital, fixed capital for investments in fixed assets, and short-term capital, working capital for meeting daily operational expenses. That's all for today. Thank you and happy learning.